You're still hawkish, looking at 3 rate hikes, and you're not even writing off 4. Why the optimism still?
Well, I think the data have been actually very good. We're adding about 108,000 jobs a month in the U.S. That's twice what we need to do to be on a sustainable level. Unemployment's below 4.5%. I see it going even lower for the rest of the year. So I think the economy is doing well. We've got good momentum. We still have a little bit of ways to go on our inflation goal, but I am pretty optimistic about the economy. I think it's, we need to continue the process we've started of getting interest rates back to more normal levels.
Let's pick up on inflation. Why aren't you that concerned about the weaker inflation data?
Well, inflation is influenced by a lot of different factors, and we've seen some I think some transitory things push inflation down. But when I look more broadly over the trends of the last couple of years, I see inflation measures moving towards our 2% goal. We're still a little bit below that, but with a strong economy that's growing at a good pace and unemployment getting towards 4%, I think that's going to give us a kind of a draft to inflation and move us to, I think, 2% within a year or so.
So if you continue to see inflation below 2%, would you have to rethink the June rate hike? Would that make sense?
Well, I'm not saying what we will or won't do in June, but I think our strategy is a good one. It's very gradual movement of interest rates back to normal. Let's not forget that even today, interest rates in the U.S. are very low. We still have our over $4 trillion balance sheet. So we're still giving the economy a good push where we have monetary policy today. Just a process of gradually moving back to normal over the next few years. So I am comfortable with where we are, where we're going. We don't want to let this expansion run too hot for too long, because I think that creates risks on the other side. So we're trying to get it just right, make sure we don't stall the economy, but make sure we don't let the economy get to an unsustainable point.
But Dr. Williams, if you see another round of weak inflation data, do you think you'll still achieve the 2% target by next year? Is that realistic? Well,
I think, I'll look at the data carefully, see what's causing inflation to move up or down. We've had some, movements in the dollar, oil prices that influence that. Try to look at more of the underlying influences. And let me, I'll be frank, if the inflation data disappoint kind of regularly, that will definitely go into my thinking about what's the right path for policy. But on the other side of the coin, like I said earlier, inflation data have been a little soft, but the data on the real side of the economy, GDP growth, employment growth, those indicators, those are actually looking better than we expected. So it's a bit of a balancing act. A little bit weaker data on one side, stronger data on the other. And so because of the two kind of offsetting effects, I haven't really changed my view on policy.
Sorry to be pushing you on inflation, but if inflation remains to be weak, are you meaning to say that you'll be more tolerant of it as well if it continues to be below 2%? Fair to say that?
No, it's not. That's a good point, because I am watching to make sure that we see signs that the inflation trends are moving back to 2%. I'm absolutely committed to seeing inflation reach our 2% goal and be there on a sustained basis. There is a background to this. We've been below our inflation goal basically for most of the last 7 or 8 years. And I do worry that we don't want that to get embedded in inflation expectations that we're accepting of low inflation. So you're right. I really do want to see inflation get back to 2%, be there on a sustained basis. So it's clearly an important factor, but I don't want to overreact to 1 month's data up or down in any case. It's really kind of this careful analysis. Is there somehow the trend not moving in the right direction? And if I did see signs of that, the inflation trends were moving flat or sideways, then that would clearly call for a slower path of rate increases than we would otherwise have.
Earlier, my colleague Matt was saying about how lots of data will be coming up, payroll, manufacturing. If they're on the downside, would you have to rethink the next rate move?
Well, first of all, I am data-driven, data-dependent, so I'm all on that. But, we do want to not get too caught up in 1 month's data being up and down. We've seen that with employment numbers where they can be volatile. Definitely seen that with manufacturing numbers, which have been pretty positive recently. So, again, dig into the data, have our team of economists study all the reasons for why things are moving up and down, and then come back to, well, what does the medium-term trend look like? Monetary policy works with a year or two lag. We don't want to get too caught up in the ups and downs in a given month or quarter, and really say, what's this telling us about the momentum we have? Now, we've seen, like I said, ups and downs in the past, but right now, when you look at the last 3 months, 6 months, 12 months, I think the U.S. economy has continued to grow pretty nicely and well above what I think of as, in the long run, a sustainable path.
You said about how your fundamental views have not really changed. So does that mean that your quarterly outlook, which will be submitted for the June FOMC, has no significant changes to it compared to what you suggested back in March.
So what I'm going to do is get my team together when I get back home after this trip, and we're going to, pour through all that data. You mentioned we're going to get more data, and we're going to reassess all of our my forecasts, whether it's about employment, GDP, inflation, and interest rates, and do that hard work. So I don't have an answer for you today. Have I come to a different view? But fundamentally, my view is that GDP growth has been. My prediction was it'd be about between 1 3/4 and 2% this year. Similar for next year. That hasn't changed yet, but we'll keep looking at that. Importantly, that weak Q1 number that we saw a while ago, clearly that's been reversed. The data in Q2 for the U.S. are looking pretty strong. The data on unemployment has been stronger than expected. Inflation a little softer. So we'll take all that into account, put it all together, and then I'll come up with my my new forecast. But I think in the big picture, if we don't just talk about a tenth here or there, my view is that we're on the same good, sustainable trajectory that I'd like to see us on.
What is the biggest risk for the U.S. economy right now?
Well, there are a lot of risks out there, and I think the typical ones I'd highlight is obviously factors outside the U.S. How does how's Europe's economic recovery go? What happens in Japan, in Asia more broadly? Clearly, those have big effects in the U.S. And so, watching the developments in China, Asia, and Europe, and making sure that we're seeing continued, good momentum in those areas. Obviously, in the United States, there's a lot of uncertainty about where tax policy, spending, other policies are going to end up, and that's something that it's outside the Fed's control. I just watch those developments as everyone does, but those clearly could have it could have an effect on the U.S. outlook over the next few years. And as I get greater clarity about some of those proposals and moving through Congress, then that clearly will be something I'll incorporate in my forecast.
You touch on China, saying that that's what you're watching. No threat of a hard landing, but are you concerned about the slowdown in China?
So I'm not concerned about the slowdown in China, because I think that this ratcheting down of growth that we've seen over the last several years is exactly what you should expect and actually should be looking for in a country that's had such rapid growth over the last 30 years. So going from 10 to 8 to 7 to 6, that to me that's a sign of realism and kind of a feasible kind of growth path. What worries me in China is not so much about this year or next year. I think that that's well under control. It is this issue of the pretty significant buildup of debt and risk in the financial system and their economy, which really poses more of a risk over the next 5 or so years. Now, China has been able to manage those risks and come up with ways to get through that in the past. So I'm not sitting there worried about a hard landing right now, but it's just watching how they manage some of those risks that have developed.
Dr. Williams, I want to touch on the balance sheet, $4.5 trillion. When do you see that being cut? And at the end of the normalization process, what are we looking at? What's the end goal?
Yeah. So I think, first of all, I think my view is that, as we've said, we were going to start the normalization or shrinking of the balance sheet once the normalization of the federal funds rate was well underway. Given my own view of the economy, where I see interest rates going, I expect us to start the normalization of the balance sheet, that first step, the baby step on that, towards later this year. That will take several years to take place. It won't be us selling assets. We'll allow the assets we have to mature and it decline organically over several years. So I think that's one of the most telegraphed kind of views.
Is there a sum?
So I'll get to that. Let me one moment. So I think that's the process. It's going to happen in the background. It's going to be boring. Hopefully, it's the dream I have about this. So there is an open question that you're asking, which is how big will our balance sheet be, say, 5 years from now when this has all happened? And that's something we haven't decided on. It will be much smaller than today. The question is how much reserves is it best to have in the U.S. banking system? 10 years ago, that answer would have been about $30 billion and keep a very tight lid on the reserves. In the future, it would be probably easier to conduct monetary policy, maybe better, if we had several hundred billions of dollars in reserves. But it's not a question of, are we going to reduce the balance sheet significantly? It's really like, at the end, is that balance sheet going to have something like $2 trillion or $2.5 trillion or something like that? Again, I'm not making decisions. We haven't made decisions. I'm not trying to communicate a decision. That's the kind of thinking I think is the right way to think about the end point of this.
Just one final question. This preoccupation with whether the Fed will move or not, good or bad?
Well, I think it is. So, the Fed decisions, we know, important for the U.S. economy, important for the global economy. And that's, people have become accustomed to that, a lot of attention to that. Again, I think my goal would be to see monetary policy become more boring as we normalize interest rates, as we get out of the large balance sheet and the unusual or the unconventional policies we did, that people won't be so caught up in will they or won't they, but will understand that it's a basic strategy. We're responding to changing circumstances. But we're not there yet, but maybe we'll get there sometime.